We're less than 90 days into this new administration, and big changes are coming to credit reporting and credit scores already, and they're going to affect everyone. If you have a credit card, medical debt, or are planning on buying a home, now, if you're planning on buying groceries anytime soon, these new policies could impact your score overnight. Today, we're breaking down 3 huge updates that are going to shake up your financial future. And please make sure you watch until the end, because number 1 is the big deal that could mean the difference between getting approved or denied for major purchases. Change number 3, buy now, pay later loans will now affect credit scores. Now, if you've ever used a service like Affirm or Afterpay or Sezzle or PayPal Pay in 4, then you're familiar with Buy Now, Pay Later or BNPL apps. They've been an easy way to break purchases into smaller payments without hitting your credit. But that is officially changing. Experian, Equifax, and TransUnion will now begin reporting BNPL accounts, meaning that they will affect your credit score for better or worse. Now, if you've been paying off these short-term funding plans with no problems, you would think that this means an overall net positive to you. But here's why that isn't actually the case. Every BNPL account you open will now lower the average age of your credit, which can easily drop your credit score. In addition, late payments on these special kinds of accounts will now hurt your credit just like a credit card, even if you're just using it to make small purchases. So if you're using multiple BNPL services, then your credit report could now suddenly show multiple new accounts in a very short period, which is going to make lenders see you as additionally risky. Now, this push is happening because up until now, BNPL providers had no real way to penalize missed payments. There was this big looming scare about phantom debt in the US because BNPL programs exist, but ultimately the risk for the consumer from them was pretty low. With this new reporting coming down the pipeline, missing a payment could hit your score just like a missed credit card or loan payment. Meanwhile, Elon Musk has expressed interest in launching a BNPL service through the platform X, which could disrupt the industry even further. Big change number 2, medical debt removal is on hold. So medical debt is one of the leading causes of financial hardship in the country of America, with 15 million people carrying medical debt on their credit reports. And how much money does that all add up to? Try a staggering $49 billion. Now, here's what was supposed to happen. Earlier this year, the CFPB announced a rule that would have removed all medical debt from American credit reports. If it had gone through, this would have boosted millions of credit scores, some by as much as 35 points overnight. But here's the problem. Russell Vought put a hold on all CFPB actions, meaning this rule is now paused for review indefinitely. And that means, as of now, medical debt will continue to appear on credit reports. Hospitals and collection agencies may move even faster now to report unpaid bills, and consumers will have to dispute medical debt the old-fashioned way, rather than benefiting from this large-scale automatic removal. Well, what can you do? Well, if you've got medical debt on your credit report already, dispute it now. The rule is technically active, and if it goes through, you could get it removed before any legal reversals happen. Now, the bigger consequence to this whole change is if medical debt can no longer be reported, you may expect a rise in lawsuits from debt collectors as they try to recover what they're owed through the courts instead. And change number 1, mortgage lending overhaul. Fannie Mae and Freddie Mac switch to Vantage 4.0. Now, folks, this is the big one. Fannie Mae and Freddie Mac, 2 of the largest home loan providers in the US, are switching from using FICO credit scores to VantageScore 4.0. Now, what does that actually mean? Well, if you are applying for a mortgage, the score lenders use to qualify you is now going to change in 2025. Vantage 4.0 weighs credit usage and debt differently than just plain FICO, which most lenders were still using. Now, more people may qualify for home loans, but the big question is, if that happens, can they actually afford them? You see, back in 2008, Fannie Mae and Freddie Mac played a huge role in the housing market crash by approving risky loans. Some experts worry that switching to a different scoring model could increase the risk of another financial crisis. And to make things even more uncertain, the Trump administration must decide whether to renew government oversight of these same agencies. If they choose not to, then the regulations on mortgage lending could disappear entirely, making loans easier to get, but riskier for borrowers and the economy at large. So while all these things are in flux, you should primarily focus on improving your credit and maybe wait until a more stable housing market comes down the pipe. The best deals always happen when others are forced to sell, not when prices are at an all-time high. So there you have it, 3 major credit changes coming in 2025 that could shake up your financial future for better or for worse. BNPL loans are going to start reporting on your credit report, so you better be careful about how many of those you're opening. Automatic medical debt removal is now paused, so you're going to want to dispute anything that you're dealing with yourself. And mortgage lending is shifting, which could affect home buyers all across the country. This is a huge year for credit, and we here at Fund&Grow are going to be keeping an eye on everything in real time and report it back to you. If you found this helpful, please like and subscribe to our channel. And if you want to know more information about changes that could be coming for the rest of the year, click on this video here, and that will go further into detail about what we see coming down the line for credit users in 2025. For everybody here, I'm Zach Ritchie. Thank you so much for joining us. I'll see you in the next one.